Have you ever wondered why, so often, the market hits your stop loss and then right after that moves exactly in the direction you predicted? You're not bad. You didn't miss anything. And no, this is not bad luck. What you just experienced is called liquidity. In the financial markets, many beginner traders place their stops in the same places, above the highs, below the lows, or around very obvious levels. The result? In those areas, there is a large concentration of stops. This is what we call a liquidity zone. The big players in the market, what we call smart money, banks, institutions, investment funds, need a lot of liquidity to enter their positions. They can't buy or sell just anywhere. So very often, price will first hunt those stops, trigger the losses of retail traders, collect that liquidity, and only after that move in the real direction of the market. That's why you feel like the market is against you, when in reality, it is simply following its own logic. Now, as a beginner trader, you have two options. Either you keep trading without understanding this mechanism, and without realizing it, you remain the market's liquidity. Or you learn how to spot these liquidity zones, wait for the right moment, and enter after the stop hunt, just like professional traders do. And that is exactly the goal of this video. By the end, you will know what a liquidity zone is, how to easily identify it on a chart, and how to use it to take smarter trades. So if you're new to trading, subscribe to the channel and like the video. It helps a lot, and more importantly, it helps you improve faster. What is liquidity really? Let's take a very simple example to make it easy to understand. Imagine you decide to buy $10,000 worth of gold on the market. For this transaction to happen, there must be someone on the other side selling $10,000 worth of gold. This is a basic market rule. For every transaction, there must always be a buyer and a seller. So far, everything makes sense. Now, let's talk about smart money. Banks, institutions, and large investment funds. They don't enter the market with $10,000. They enter with millions of dollars. And here's where the problem appears. If an institution wants to buy $10 million worth of gold, there must be someone on the other side selling $10 million worth of gold. And that is extremely rare. So what do you think they do? Do they just sit there waiting for a miracle seller to appear? Of course not. What they do is create liquidity. How? By trapping small traders with false breakouts, false signals, and misleading price movements. Then, price comes back to hunt the stop losses of small traders. And those stops are actually market orders. This is exactly the liquidity that allows institutions to enter massive positions. And once they are in, the market can finally move in the real direction. That's why liquidity is so powerful, because it is what drives the market. And if you finally understand how liquidity really works, what comes next will completely change the way you trade. The different types of liquidity. There are two main types of liquidity that you absolutely need to know. First, external liquidity. This is the most important one. External liquidity is found above highs, below lows, at equal highs, and at equal lows. This type of liquidity is used either to change a trend or to continue a trend. Now let's talk about internal liquidity. Internal liquidity is found inside a range, during pullbacks, and in microstructures. It is mainly used to reload positions. Now let's look at a real chart example to see how to identify an external liquidity zone. On this example, we can see that price formed a clear low. This zone, therefore, becomes a liquidity pool. Later on, we can see how price comes back to collect this liquidity. And once the liquidity is taken, price continues its move. Now, here is the key question you should always ask yourself when you want to identify a valid external liquidity zone. What is the highest high or the lowest low of the last move? Mark these two key zones and wait for price to return to the zone, break it, and then re-enter the zone. That is when your liquidity is validated. Now let's talk about internal liquidity. Internal liquidity works almost the same way as external liquidity. The only difference is that it is located inside the price move. It often appears in the form of false breakouts or fake breaks of structure. Price breaks the structure, goes to collect liquidity, and then re-enters immediately. This type of liquidity is used to add to existing positions. To make sure you fully understand, let me take a second example. On this example, we can clearly identify two external liquidity pools, thanks to this high and this low. These two areas represent key liquidity zones. Later on, we can see how price creates a new internal liquidity pool. Then, the market comes to take that liquidity before continuing its move. After this break, which confirms the continuation of the bullish trend, the market creates another internal liquidity zone. And once again, it comes back to take that liquidity before rallying aggressively. But from that point on, we can notice something very important. The market no longer breaks the last high. This is a potential sign of a trend change. In addition, we can see that price gets rejected multiple times from this zone. And that is exactly what smart money looks for to enter the market. And you can see how the market then comes to liquidate all that liquidity before moving to the downside. Fundamental rule to remember. The most attentive viewers have probably noticed something. From the very beginning, I always respect the trend. I never look for liquidity against the trend. To go further, there are more than two types of liquidity, such as trendline liquidity and other structures. But the two I just showed you, external liquidity and internal liquidity, are the most important ones to master if you want to become profitable. Now, how to enter a trade. Once the liquidity zones are identified, always wait for the sweep. This means the break of the level followed by a price re-entry. Never enter during the sweep. You must wait for the market reaction after the liquidity has been taken. Now let's talk about entry techniques. At this stage, you have two possible entry methods. Option 1, direct entry. You enter directly when price breaks and re-enters the liquidity zone. It's simple, but it's mostly reserved for experienced traders. Option 2, confirmed entry, which is the safer option. You go down to a lower time frame. For example, if you identify liquidity on a higher time frame like D1, once price breaks the zone, you drop down to a lower time frame like H1, and you carefully wait for a structure change, a BOS or an MSS. Then you wait for a re-entry to enter the trade. Other common examples, H4 to M15, H1 to M5, or M15 to M1. Now you understand something that most traders never really understand. You now know what liquidity really is, why the market needs it, and why price so often comes to take stops before making its real move. You've learned that liquidity is not random. It is not manipulation. It is simply how the market works. You've seen that there are two main types of liquidity. External liquidity, which is mainly used to change or continue a trend, and internal liquidity, which is mainly used to reload positions inside a move. You've learned how to identify them on a chart, how to spot the key highs and lows, how to recognize liquidity pools, and most importantly, how to wait for the sweep instead of jumping into the market too early. You also learned a complete and simple trading process. First, identify the trend. Then, mark the external liquidity. After that, locate the internal liquidity near a strong institutional zone like an order block or an FVG. And finally, wait for the sweep, wait for the reaction, and only then look for your entry, either directly or with confirmation on a lower time frame. And this is the biggest difference between losing traders and consistent traders. Losing traders chase the market. Smart traders let the market come to them. From now on, you should never look at a chart the same way again. You should no longer see random movements. You should see where liquidity is, where stops are, and where the market is most likely to go. But remember one very important rule. Always trade in the direction of the trend. Never hunt liquidity against the trend. Mastering liquidity will not make you rich overnight, but it will give you something much more important: logic, patience, and consistency. And in trading, that is what really makes the difference. So if this video helped you, make sure to like it, subscribe to the channel, and share it with another trader who is still struggling. Train your eyes, train your patience, and let the market show you the way. I'll see you in the next video.